All right, so we are at the hour. I want to thank all of you for taking time out. For those that have not been on this call before, the format is we do a weekly chat. I'm speaking on some subject, market related, or investment related, or insurance related. Nothing's going to be sold here today. We're just trying to educate you on what we're seeing. The monthly recap of the market is sort of a Monday day quarterback, allows us to sort of take a step back and look at what just happened and then sort of compare that to what we're hearing and seeing into the future, and then make adjustments based on strategies versus knee-jerk reaction. Because the one thing I do know is that the media loves to create headlines. Yesterday or 2 days ago, the market's off 600, market's off 800, right? I mean, it no sooner happened and it was there. And then by the time I looked, it was only down 600, but the news was, it was at 800, right? But the market's up, the market's up 100. I mean, they just are looking for something to say. We have to remove emotion from our investment strategies as we go forward. So before I get into this topic, which typically takes us about 15 minutes, I want to bring to your attention that September, it is Life Insurance Awareness Month. So Jeff Wiggins is an advisor of mine that I've known for 10 years, 58 years old. And last Monday, I got a phone call from his 25-year-old son. And I can tell you that I heard extreme pain in that young man's voice. He has two younger sisters. I eventually talked to his wife, and Jeff Wiggins passed away working on the farm down South Carolina. He was out there pulling down a tree with the tractor, and it fell on him. And it's a couple times this year where people that I've known pretty well have died suddenly. Nobody wants to talk about life insurance. I get it. It's a horrible subject. We don't like to think about it. But as I was helping the family start to look at what Jeff had acquired, he did follow a lot of his own advice, right? He did have some permanent life insurance in place, and his family will be okay. And that is, at the end of the day, the message. But there's some questions. You can write these down. Just ask yourself, do you have coverage? If so, how much coverage do you have? Right? And this should be an exercise for both you and your spouse. Is it term or is it permanent? If you have it through work and it's group insurance, right, will you lose it when you retire? What happens if you pass? Everybody thinks about, it's only going to be for the person if I'm not here and they just need enough to bury me. And that's usually not a correct way to size up life insurance. If it's term, when does it stop? Is it because you stopped working or because the term period ran out? Who are your beneficiaries? This is the one where, if you're not paying attention and you put something in, 5, 10, 15 years ago, you didn't really know, you left it blank, it should be reviewed. At a bare minimum, collect your documents and put them together. That was the thing that this family found out last week, is they did not know where all of the documents were. Now they finally found them. But if, think about it, it's taken for the person not to be there for everybody to go through every piece of paper in the house. Make things easier. So I just share that with you because, again, September is Life Insurance Month. Hug the ones you're with. Every day is a gift. And let's just make sure that we appreciate the ones that are here. So this week, we're talking about August, what happened last month. And this is, for those of you that do not know, is a snippet of the performance of some indices that on a monthly scale. Now, monthly is not really telltale, but what are some things that I see here as I look at it? And for the most part, most of the equities markets had positive returns, right, for 1 to 2%. The only laggards, gold, just about caught up, and commodities, right? So, but on a monthly snapshot, we don't do things on a monthly, and even yearly isn't necessarily the accurate. But let's compare that to how we've done year to date. Year to date, commodities are all the vogue place to be, right? In real estate, right? And last year, these two got crushed. So they are leading the pack this year. The S&P does seem to be on an upward trend, right? So that's the red. So year to date, as much as the market had some volatility of late, and if you recall that we said probably around March, April of this year, that we see things still continue in an upward trend until the third quarter. Volatility in September, especially, is an area that is usually volatile, and I think evidence of this week. But this was August chart, and things are still looking good, followed closely by the S&P, and then we have the European nations, developed countries. Now, the pink is underdeveloped countries. I like to call these emerging markets. I usually reflect on, like, say, China, right? So no bleeding hearts here if if they're not doing well. And then again, some of their, I think, real estate holdings are coming under pressure. So, that's an area, just from a specific point, microscopic point, be careful. And then gold, which was, again, the place where people typically fly to for a feeling of safety, is still down on the year, right? So we compare that to income portfolios. For those who have not seen this chart, this is what we call the three wise men. There's three indicators, right? We have the RSI, relative strength index, we have the MA, moving average indicator, and then we have the MACD right down here. These three indicators, when they trigger, RSI is relative strength index. If all three of these triggers get activated, 1, 2, 3, right, it will create a red line. This is in 2000. And then we can see that stayed downward pressure for almost 3 years. And then by the time it finally turned up, this was a bull market. And then, as you can see, there's been a couple head fakes in here, right? It turned around and said, oh no, we're gonna pull back. But right here, it turned around and corrected, and we still had an upward trend. We're now all the way to the right. This was COVID right here last year. And even though we got a red indicator, we had suggested to a lot of our clients to ignore this signal and let's step back into the market versus having some automation say, okay, 6 months has passed, it's okay. We would have lost some of the upside. So again, we have an investment advisory firm watching every day, right? Telling us and giving us suggestions. But right now, we still continue to see an upward trend on all the indicators, and that's good news. So right now, equities, although we've seen some volatility of late, we're not making any predictions yet, but we are watching closely September and October to see how the end of the year will fall out on if there's going to be any adjustment. That brings us to income markets. And income markets, this is a snapshot for the month. And as you can see, everything lost money for the month except for high yield corporates. The blue line, high yield corporates. And just think about it. People, we've talked about, people are looking for, if you're retired and you're counting on income, you're trying to get as much, if you need X amount to live, and that was coming from some type of strategy that maybe included muni bonds or high yield bonds. High yield, substitute the word high yield with junk. It's above average risk. So again, 1 month does not the market make. So let's take a snapshot of how are we doing year to date. Year to date, let's look at the leader is a high yield muni. So a little above 4%, a little bit above. But what I point out with muni bonds is muni bonds are typically for accredited investors. People typically in all investment training classes, they'll say they're typically for people that are looking for tax-friendly environments. And high yields, as much as they're touted as being tax-free, are not completely tax-free. But, right there between 4.5 and we'll say 3, right, close behind high yield corporates for the year. Again, people are chasing corporates. So if you had $1 million in corporate high yield bonds, you might be able to get 30 grand out right now. And is that what you were counting on your portfolio when the typical rule of thumb, Bill Benton was talking 4%? If you had some exposure to just normal munis, and then any of the Vanguard Total International bonds, right? We've talked about bonds and bond pressure on a go-forward basis. Bonds in general do not like rising interest rates. And it is an area, although the Fed has said, hey, they're going to pause any easing and they're going to pause, right, any tapering, right? They are, looking into the next 2 or 3 years. The market liked it today. At some point in time, they're going to call that note. They're going to say, hey, we have to raise. But right now they're saying after some of the storms that we're seeing out there right now, right? So whether it's COVID, the pandemic, whether it's, the border crisis that exists or doesn't exist, whatever's going on in the world, there's always going to be something. And, markets, when you're looking to be retired on fixed income, interest rates right now are close to 0% from the Fed, 0.25%. Like they're next to nothing. So that is not sustainable. Just logically speaking, we cannot stay here. So this is why I've spent ad nauseum a lot of time talking about being exposed or overly exposed to bond holdings in general, whether it's with me or in your 401k or your TSP or your IRA, or you're doing your own investments, you're buying these bond funds. You're like, well, why did my bonds lose money? And that's because if you recall some of my past presentations, that they have an inverse relationship. When interest rates go up, your bond value, the price, because quite often the mutual funds that you own are going to sell it and can buy a bond, right, at a less expensive price, right? So at the end of the day, when I look at this chart and I see all the pressure that is there, and even 20-year treasuries, which were all the rave last year, are still negative on the year, right? So people, just bottom line is the markets are constantly changing. We don't know where things are going. But we can be defensive in our postures by not being overly exposed. If you said, hey, Chris, where shouldn't I be? I would say in the bond market, right? But right now, we've talked about this upward trend. We've had this green line, right? So this has been going for a while, but I'm just telling you, it's close. It's close for one. There's one crossover right there. This one has not hit yet, right? It's close. I don't know when it's going to happen, next week, next month, 2 months, next year. But at some point in time, it's going to turn red. And it will just put pressure in this arena. And then the flight to safety is, okay, so let's just think about it, right? Where do we put money where, all right, we want to be in the market. We're in equities, right? And now the Fed starts saying, hey, listen, we need to raise the interest rate. Well, that's going to spook the markets in general, right? And then bonds in general, which don't like rising interest rates, you have a double whammy here. So just be cautious. This is where diversification comes in. This is where, and remember, all the news that we hear on the media, it's such a myopic view of what the overall reality of most markets are. This is why we like to use ETFs, right? At a bare minimum, mutual funds, spread some of that, pick some sectors, pick some strategies that are well suited to you. And this way, when you turn on the TV and the media is trying to spook you, right? You can turn around and say, you know what, that may be true, but it's not necessarily true to your portfolio, right? So with that said, we have a unique indicator Formula Folio has created. It's called the Recession Probability Analytics tool. And basically the black line in the 50, it just takes 100 metrics and it assigns a value. And then it turns around and it measures that every month. It takes all that data and it says, hey, how are we looking? For those of you that have been on my call, know that we headed into recession territory during COVID of 2020. March and April, it went above the black line. We look at September, October, we've been below the black line. Things have been continued to be good. But however, we are seeing since May this upward trend. I don't know where this is going to go, but we are watching every month. This is where I was saying towards the third quarter, fourth quarter of this year, we might start offering or suggesting more caution in how we're actually invested in what we do. So it's a little premature to tell, but that's our update for right now. I want to thank all of you for being on the call. Again, you guys are valuable to me. I try and do these every week and bring value, bring content, things that I'm seeing out there. And then as I had a scare, for my staff knows this, but I don't think I shared it with anybody. I woke up Wednesday morning and I couldn't see out of my left eye. You talk about scary, right? I mean, I was freaking out. And, I'm like, I've lost weight, I'm doing well, I wasn't hitting the head. What is going on? I went to the doctor and, I'm still got some tests to do, but my vision has returned to a degree. I do have a floating spot, but just like that, to me, it can happen. And so when I say that I genuinely care about everybody on this call, I'm here to help. There are things that sometimes we get so caught up in trying to pay the bills, or we want to move, we want to get out, or whatever. Just make sure you absolutely hug the ones you're with, right? We have a very finite amount of time on this planet, and I'm an absolute fan that you got to love the ones and hug the ones that care about you. So if nobody told you they love you today, I'm going to be the first. I miss you all. Hope to see you all. If you need me, call me. There's the office number, and have a great day. Bye-bye.